what will be the effect on current ratio if goods are sold at profit for cash? So suppose our current ratio was 20,000 is to 10,000, means 2 is to 1. Our current assets were for rupees 20,000 and current liabilities were for rupees 10,000. We have sold the goods on profit. We assume that the cost of the stock was 800 rupees, but we have sold it for rupees 1,000. So what will happen? We'll receive the cash rupees 1,000. It will increase our current assets, and we'll lose the stock worth rupees 800. It means we'll lose the current assets for rupees 800. So the net effect will be 20,200. Our new current assets will be 20,200, but there will be no effect on current liabilities. That will remain 10,000. So new ratio will be 20,200 is to 10,000, means 2.02 is to 1. It will improve our current ratio. Suppose the next situation is goods are sold at loss on credit. How it will affect our current ratio? Suppose at present our current ratio is 20,000 is to 10,000, means 2 is to 1. We have sold the goods at loss on credit. Suppose the cost of the stock was, means goods was 1,000 rupees, but we have sold it only for rupees 800. So what will happen? When we sell the goods on credit, we increase the debtors. Means we'll increase the debtors for rupees 800, but we'll lose the goods for rupees 1,000. So the net effect will be 19,800 is to 10,000. Means the new ratio will be 1.98 is to 1. So if goods are sold on credit at loss, it will decline our current ratio. Suppose sales at par on credit. So what will be the effect of this transaction on our current ratio? Suppose the original current ratio is 20,000 is to 10,000, means 2 is to 1. And goods are sold on credit at par. Suppose the stock worth rupees 1,000 was sold for rupees 1,000, means at par. So what will happen? We'll lose the stock by rupees 1,000, means we are losing the current assets for the same amount. And on another side, we are creating debtors in our books because the goods have been sold on credit. So the current assets will increase due to debtors rupees 1,000. So the net effect on the current assets will be the same, means new current assets will be 20,000 and new current liabilities will be 10,000, means 2 is to 1, means no effect. Suppose furniture is sold on cash at loss. What will be the effect on current ratio? Suppose the original current ratio was 20,000 is to 10,000, means 2 is to 1. We have sold the furniture at loss. Suppose the cost of the furniture was 1,000 rupees and we have sold it only for rupees 800. So what will be the effect on current assets and current liabilities? We have sold the furniture for cash. It means it will increase our cash for rupees 800. And it's not going to affect our current liabilities. So new current assets will be 20,800 is to 10,000 rupees. Means the new ratio will be 2.08 is to 1. It means it will improve our current ratio. Now we'll talk about quick ratio. It's also called liquid ratio. Actually, this ratio tells about whether the firm is capable of paying its short-term liabilities. Here, short-term liability means which are to be paid within 1 month. So whether the firm can pay the current liabilities within 1 month or not. So this is the definition, and the formula of this ratio is quick assets, or you can call it liquid assets upon current liabilities. Actually, there is not much difference between current assets and liquid assets. Only stock and prepaid expenses are excluded from the current assets, and it becomes liquid assets. The reason being, we cannot rely on the stock that it will be sold regularly within 1 year, because it always depends upon the market fluctuation. Sometimes the firm is not capable of selling the goods in the same flow. So that's why we never include stock and prepaid expenses in the quick assets. So I can say that quick assets is equal to current assets minus stock and prepaid expenses. So it establishes a relationship between quick assets and current liabilities. Suppose in a firm, current assets are 2 lakh rupees, stock is 50,000 rupees, and working capital is 1,10,000 rupees, and you are asked to calculate quick ratio. You know, the formula of quick ratio is quick assets upon current liabilities. In this question, what is the value of quick assets? You know, quick assets are not clearly given in this question, but we have been provided current assets and stock. You know, quick assets is equal to current assets minus stock. That is 2 lakh minus 50,000 is equal to 1,50,000. And current liabilities are also missing. But we have been given one hint, that is working capital is equal to 1,10,000. You know, working capital means current assets minus current liabilities. So working capital is 1,10,000 is equal to 2 lakh minus current liabilities. Or we can say 2 lakhs minus current liabilities is equal to 1,10,000. So current liabilities will be equal to 2 lakh minus 1,10,000 means 90,000. In this way we have got current liabilities rupees 90,000. So quick ratio will be equal to 1,50,000 upon 90,000. That is 15:9, or we can say 1.7:1. Generally 1:1 is considered as the best quick ratio.